Good afternoon. My name is Josiane Ménard. I'm a press officer for the Banque of Canada, and I'll be moderating this press conference. Governor Poloz will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone right there, which my colleague will pass by. So please simply raise your hand. We will do one question and one quick follow-up to ensure everyone gets a chance, and then we'll see how much time we have left for a second round. The Governor will be happy to answer questions in both official languages. Avant de poser une question, s'il vous plaît, on vous demande de vous identifier. Je vous demanderai aussi d'utiliser le micro sans fil et bien sûr, vous pouvez poser la question dans la langue officielle de votre choix. Governor Poloz is ready now to take questions, so who wants to start? Randall?
Governor Poloz, Randall Palmer from Reuters. Can you speak to how high the bar is to raising the inflation target, and particularly in light of how difficult it will be to convince people on fixed incomes or with fixed investments that it's good to have their savings and their pensions and the loonie eroded faster?
Well, Randall, all we've done is open up the research agenda that we're working on. We have set aside most of the next year to do this work. And that question you raised is on our list of questions to understand better. We don't have any position on that at this stage. And when I say the bar is high, is to say that the inflation targeting regime as we know it today has served us extremely well. It certainly has brought stability. It certainly helped us in troubled times such as during the crisis and so on. So the bar is high to change it, but that doesn't mean that we shouldn't at least examine carefully what new thinking there might be around those parameters, including such things as how we formally integrate it with financial stability issues, which is the subject of my speech down at Western University. So all those things are on our to-do list, but we haven't even researched them yet. Neither are other central banks. This is the research agenda that's just underway at other central banks too. So we'll be talking to them, our colleagues in other central banks over the next year. So I have no preconceived view on it.
Does it make a difference that the lower bound doesn't seem any longer to be zero, but negative in some cases, as in Europe? And would it make a difference if the Fed stays with 2%, and given that the effect that this would have, that a 3% Canadian target or something like that would have on the value of the Canadian dollar, presumably it would devalue 1% a year if all other things were equal?
Well, on your first point, is definitely part of the consideration would be, what are the risks you face in terms of your ability to withstand shocks to the economy when you face a zero lower bound? So if you have a zero lower bound and a 2% inflation target, that puts a kind of a ceiling on how high your interest rate is and how much room to maneuver you have as a central bank. And obviously we've discovered two things. One is that we didn't really have enough room to maneuver over this past cycle. But you have to evaluate how important is that type of shock. Have we changed the financial system in ways that make it less likely, which I think we have. So you have to take all of those things into account. And then the extra thing that you mentioned is that, yes, through events of the past year or so, we have learned that the zero lower bound may not be as hard as we imagined it was in theory. And that's a very complicated question. So that's all to say there are a lot of things to put into that analytical bucket, and we simply have not done the work yet. So I'm not going to prejudge it in any way, and make it clear to people that we are open to discussions from academics or from professional staff in other central banks or ourselves as to what truly is optimal given the experience that we've been through. Well, look, you know that we're an independent central bank, as are other central banks independent, and but certainly the research which goes into those kinds of questions is something that we all share across the central bank network. It doesn't mean we would all arrive at the same conclusion, But of course, it means that we would understand very well what everybody else was concluding. So at this stage, I really believe it's premature. We can have this conversation a year from now, and I don't think the work will be done. So all I can talk about is in theoretical terms. Those are the things that are on the table.
Greg Quinn?
Greg Quinn, Bloomberg News. Governor, we have seen that it looks like energy companies are cutting their capital expenditures by, say, 20 to 30% in response to the oil shock. Is there a risk of some permanent damage to Canada's economy from this in the same way that we saw some permanent damage to manufacturing and exporting through 2008?
Well, there's a risk, but it's obviously conditional on what the outlook for oil prices is. I don't have a crystal ball on that. As you know, in our own monetary policy report, we simply take the last number of weeks before we publish and extend that out as an assumption, and then we analyze around it to make sure that as a central bank we understand the risks that we're facing on both the downside or the upside. But the way the process is supposed to work is in reverse to what we talked about when oil prices were rising. When oil prices are rising, people in the world are prepared to pay much more for something that we're producing than in the past. And the fact that prices are rising, the dollar tends to rise along with it, kind of gives you this signal to invest more in that part of the economy and less in the other part, general term. And now that prices have fallen by around half or thereabouts, close to half, that some of those signals are being reversed. Excuse me. And whatever process you imagine on the way up, it's the opposite on the way back. And it just means that the economy operates at different speeds at different times. So we had a fast speed energy sector and a slower speed manufacturing sector for a number of years. And now we're expecting the reverse to be true. To what extent some of that is permanent or is very hard to say. But usually in the commodity space, it's all about knowing where it is and whether you make the investment now or you make it at a different time. You know, that's sort of a long-range plan that such companies work with. What I am encouraged by is the decline that we observed in costs throughout the energy system, that is, so suppliers and services. And that suggests that we are steadily improving our competitiveness in that sector for a given oil price. And so that makes it also very difficult to predict how all that will turn out. That's why I allude to the uncertainty in my talk.
Also in energy, it seems like today you've made a distinction between an oil shock that was faster than you expected at first, but not larger than you might have feared. Are there implications for that for the economy or how you set policy to have an oil shock that is very perhaps short but sharp and not a prolonged shock?
Well, it's important to bear in mind that when we say faster, not bigger, it's not over. Okay, so that's an important subtlety too. So when the energy sector cuts back, as you described, in some cases, or say around 30% of capital spending, which adds up to almost 10% of Canada's total capital spending. That's a major shock, and it stays down as long as oil prices stay down. So it's not about it reversing itself. It's long-lasting and persistent. But what we're talking about is the other things, which are picking up speed, coming from beneath that and being more noticeable in the macro data, and why we use the term partial rebound in growth in second quarter is that we believe growth will add up to being positive, but that's because there's enough positives to outweigh that negative. But it won't be a full rebound yet until much later in the year, sometime in the second half. So that if you see that picture of those two speeds, and the faster speed is sufficient to become the leading sector, that takes time for the levels to be big enough for that to happen. So the biggest uncertainty that we face then is how quickly, is the shock over in terms of going down now, or is it still got further to go down? So that's the difference between bigger versus faster. Faster, we think, we know how big the shock is because oil prices are very observable, and we can see in the granular data evidence that the reaction was already taking place in the fourth quarter, which means if you know how big it is, then it started sooner than the first quarter. And so the first quarter is what it is, we think around zero. If there's no further downdraft, then we think our forecast of a partial rebound will hold up. But if for some reason companies decide to take another leg down as we're sitting here more or less, that will affect the second quarter, and that would be a revision to our view. But right now we have no evidence to point to of that. Some of the effects of the oil shock take longer to show up in the data, such as the employment effects. So that's always the last indicator to do the moving. So that won't count the same as the spending decisions and stuff. Does that help you? Okay.
Carrie Campbell, CBC.
I wonder if you could maybe summarize the effects you've seen or the effects you might expect to see into the near future when we look at the economy of Prince Edward Island as a result of the drop in oil prices.
Sure. Well, Prince Edward Island is one of those cases where you'd expect to see the effect of the things that I said were positive should show up more immediately because you don't have the same negatives to knock them out of the way. So the positives would be everybody this year saving, say, $500 per household on gasoline for their car. Those who are renewing their mortgages, saving money on their mortgage. The U.S. economy picking up speed in the second half of the year. And the exchange rate effect kind of adding both to the immediate revenues of those exporters with existing contracts and making them more competitive to penetrate more into that growing, regrowing, reaccelerating U.S. market. So those are all positives. And so I expect to see those much more visibly over the next 12 months than we have in the past 12 months. So I don't have a Prince Edward Island forecast to give you, but I can tell you that the ingredients are good ones. And you shouldn't underestimate the effect of these things on tourism, which I know 2014 was a very strong year for the island because of the I don't know what you call that centenary, but it's the 150th year. It's got a fancy name, but anyway, I'm sorry about that. But that brought more visitors than usual. But my sense is that the ingredients, those folks who came last year would say, gee, it's even a better deal now, so let's go again this year in 2015. Because I think all you have to do is visit here to realize you should come more often.
Do you see any possible role for a provincial government in trying to make sure that local businesses are able to capitalize in the sectors where we do see these opportunities and growth?
Well, I don't give advice like that. I can certainly say the ingredients are there as I've described them there, and there are always things that governments can do, but I won't comment on them.
We have about 5 more minutes. Randall?
Governor, you remain bullish on the second quarter picking up to some extent. To what extent are you concerned that the U.S. second quarter is slow to pick up? Do you see it being slow?
It's hard to read right now, and that's why we're not. I'm not offering you a new forecast today. We're still talking about the one that we wrote down in the April NPR. And we'll have, of course, we have a decision next week, and then 6 weeks from now we'll have a whole new forecast in July. The U.S. economy slightly puzzling right now. Certainly easy enough to account for things through the Los Angeles port disruptions and the weather. That all sounds temporary, but certain elements of it looked less so. And for one thing, the consumer may be saving a bit more of their lower gasoline price windfall than you might have assumed. It's hard to have concrete data on that, but the labor market indicators have remained very solid through all this. And so, it has all the signs of an economy that will rebound as opposed to, continuing these weaker numbers. But I think you should bear in mind that a quarter is kind of an arbitrary time measurement. So, if it took until May data for the rebound to appear, that would still look good in the second quarter. It looks a little bit like April wasn't quite up to speed. But it's still very early days when it comes to looking at what the second quarter might look like. We really won't know in Canada, we won't know until the end of May on how the first quarter really looks. And so I think we'll just be a little bit more patient. We think all the ingredients are there and have a lot of confidence that it will rebound and be stronger in the second half.
And though you are the last line of defense on real estate crashes, with all the other elements that could be used before the Bank of Canada, still does the extraordinary run-up in prices in Toronto and Vancouver, could that be a factor in your considering if you ever want to cut rates further? Would that be a factor, the fact that there is such a risk of a bubble in those places?
Well, as we discussed in detail in that paper on uncertainty and risk management from last year, there are when everything is within the zone of balance, we called it in that paper, that is where there are risks on the upside, there are risks on the downside, then you have financial stability risks which enter that conversation. And it's in that zone where that kind of trade-off can be of some significance. In contrast, when we saw the oil price shock in January, when we were analyzing the oil price shock that took place during the fourth quarter and into January, that was a sort of shock which throws us out of that zone of balance, if you like, and so calls for a policy adjustment and then sets a new zone of balance. So those considerations are ever present in our discussions. We don't take them lightly at all. And of course devote considerable resources to our FSR, which is of course underway now because that'll be published in June. And so we watch that with considerable attention. As you say, we aren't the first line of defense, but we take it all into account given the decisions that we are able to make.
And we have time for one last question. Mr. Campbell?
Okay, I have to read this one. There's been warnings in publications like The Economist lately that fossil fuels could become stranded assets as governments tackle climate change. Has there been any consideration from the bank that over the long term, oil, natural gas, coal resources might be worth less than current accounting shows?
No, we have no particular analysis of that issue, nor is it really an issue for the Bank of Canada. It can be an issue for some central banks who have a regulatory function because it may be something that affects the insurance business or other financial intermediaries. But I have no particular answer for that. If somebody has another question, I'll take it. Okay.
One real
this
quick.
This will be the real last question.
This really will be, yes.
Quickly then, there's been a lot of disappointment in the pace of the global recovery and Canada's non-energy companies. Mm-hmm. What is it about this year that makes it it gives us a lot of optimism about this is a point where non-energy exports will really be taking off in Canada now?
Well, the superficial answer would be because the numbers have picked up. So we were careful well, last year when we did that analysis and we figured out which of the 15 or which of the 31 sectors are more likely to be leaders and which ones contained all those companies that are gone now. Okay, when we did that analysis, those 15 that are expected to lead are leading. They're growing by around 9% over the past year. That's very significant growth in a 2% economy. That's pretty special stuff. So it's all a question of how long does it take for that to translate into, in addition to the export sales, the investments that go in behind it and the job gains that go with that. That's the natural sequence that we're watching. And that would be fed, as I mentioned in my speech, by the creation of new companies in sectors that we haven't talked about yet. So that process has all those elements are in place. We can see them growing. And so that's the first answer, that we're getting more optimistic because it's actually been happening. The more fundamental reason is because those sectors underperformed before because they're closely tied to investment spending by companies in the United States, not spending by consumers. And so what we've been waiting for is for the U.S. recovery to switch gears from a consumption-led to an investment-led or fueled recovery, and that began last year. And so those things are connected. And the next step will be for our recovery then to also get stronger investment. So we forecast that the non-energy investment, the non-energy sector investment program will be much stronger than, of course, the overall. The overall will be weighed down this year, especially by the oil price shock and its consequences. So that's one of the clearer places where you have a negative and you're waiting for those positives to actually outweigh it. And it'll take into the second half in the investment side for that to take place.
And that will conclude our press conference. Thanks for coming.
Thanks, everybody.